Good day, everyone. This is the second part of strategic management and costing systems. In the previous session, we have actually discussed two items, activity-based management theory and costing, the technique. After that, we have, of course, the product life cycle costing. So both the theory and the costing. Now for the second part, I'm excited. It will be on the other techniques, statistical control techniques and other quantitative techniques. From the word statistical, so basically there would be computations, there could be softwares to be used, and the techniques would be mostly numerical in nature. So these operations research models are used to map up processes, monitor and evaluate quality indicators, or when you say indicators, then the, let's say, red flags, or we can say that these are the reminders therein about quality and provide intelligent alternative solutions afterwards. So let's see. Examples would be lines like the regression line and the line graphs. So we can imagine our mathematics showing graphs and showing straight lines. But by the way, lines could not be straight, could be curved also. So we have to be careful by the word line that is used in mathematics, because although it is called a line, but it's not really like straight for some. Curves could even be called lines. Graphs, like bar graph, histograph, then we can also have there the pie graph or chart. Then that's the circle one. Dispersion or deviation. So we now employ our statistical methods. In this case, for example, X graph, R graph, P graph, etc. So we can be using, for example, the normal distribution for dispersion or deviations. And we can also make use of the computations like the ANOVA, analysis of variance, theta, z-test, etc. So these are the items to be discussed here. Others could be Gantt chart, wherein we have the dates, and then the dates would be matched to the specific activities that are to be done. From the start, for example, of the planning stage, then up to the time that everything is ready to be implemented. Okay, so from start of planning to the start of the business, for example, for a business plan or for a project. Then Pareto's law, you will know that regression analysis, which is one that I've discussed, like for example, there are plenty of variables, like with so many x variables, independent variables, what would be the result to y or the dependent variable. So we can make also a graph for that one, a straight line. Fishbone analysis, that is the cause and effects relationship. Linear and dynamic programming. So linear could be the straight line and changes along the way. Like we can connect sensitivity analysis. So for example, if one variable change, so what will happen to the other, and learning curve theory, that as people would be exposed to a lot of situations related to things, then they would learn more along the way. And thus that would increase their production with lesser time, for example, if the variable is time. All right, so these particular techniques will be tackled one by one along the way. There are plenty also of discussions, so please take charge of going over or reading them. What I've not mentioned is all about Pareto law, which is the 80-20 rule. Basically, like 80% that happens, or the occurrences that happen, is accounted by 20% of people, for example, or area, and etc. So this is the Pareto law, which is applicable to a lot of fields and business processes, and then in social science, of course. Okay, so let's begin with the learning curve theory. You can see here the graph, wherein this is the productivity rate, this is the time. So time is the independent variable, that's the x, and the y is the productivity rate, which is the dependent variable. So as we progress over time, we can notice that our productivity increases to a certain point, up until such point that it remains constant, or later on it would decrease. So that's the law of diminishing marginal productivity later on, which anyway can be discussed here, but discussed exhaustively in economics. So returns can also be considered because productivity is here. Okay, to continue, learning curve theory, which states that productivity rate marginally increases as employees gain experience in his work. So more time consumed, assuming that the more the time that is consumed, the more learnings there are. So the employees are serious about the job. So the more that the production would increase. So increases in efficiency would be an average of 20% for every doubling of the items for a while. Okay, so for every doubling, I think there's something cut here. It's not continued. So that's why it's called up. It's 530, then 531. Anyway, the point is that the average output would increase, especially the efficiency, by 20% by every double of quantity of output. All right. So anyway, there are two models used in the learning curve theory, the Wright model and the Crawford model. So the Wright model is that in each time the cumulative quantity of output doubles, the cumulative or moving average time to produce per unit decreases by a certain percentage. And then the decrease is 20% in terms of the time. So in other words, there is an average of decrease of time by 20% when units would double. Okay, that's the cumulative quantity, of course, meaning the addition. Okay, so that's it in relation to time, which is also addition or sum because it's cumulative. On the other hand, for Crawford model, that is incremental unit time learning model, predicts the time to require to produce the last unit and requires getting the total of each unit's time to compute cumulative total time and cumulative average time per unit. So basically, we just have to add the time required to produce the last unit and the total of each unit's time to produce cumulative total time. And divided by the number of units cumulative, we get the average time per unit. So example, we have the cumulative average time using the Wright model. So a while ago, I've discussed that the Wright model shows to us that as the cumulative quantity of output doubles, then the average cost of units would decrease by 20%. All right. So here are the average right time. It's the time rather, the time to produce. Okay. So the time moving average labor hours per unit decreased by 20%. To get the after effect of that, we can just multiply the prior number of hours per unit by 80%. So 20 times 80%, that's 16. If we want the long method, so 20 times 20%, that's 4. 20 minus 4, 16. And we can continue the process. So what we can do is that multiply those values by 80%. And the estimated total hours to produce the units then would be the number of units multiplied by the moving average labor hours per unit. Direct labor cost, this is a variable cost, is constant per hour regardless also of the activities. And the total direct labor cost would also change, of course, would increase as a whole. And then the average direct labor cost per unit, actually, we can notice that it decreased. So going back to the theory, cumulative quantity of output doubles, so 1, 2, 4, 8, 16, 32. Then the cumulative or the moving average time to produce per unit decreases by a certain percentage. It's 20% for this example, but it can change depending on the industry, most especially if that is machinery that we are talking about. So that would have higher rates of decrease in percentage. Okay, so we can realize here that as the number of units produced doubles, the average labor hours per unit decreases. Yeah, you can see it here. It doubles and then this decreases, right? Take note that the average labor hours per unit decreased. So it's normal that the average direct labor cost per unit would also decrease with per hour as constant. The average direct labor cost per unit decreases by 20% as the number of output doubles. I think if we are really into mathematics, we can really know this. Why? Remember, there is a change of 20%, it's decrease. Then we employ multiplication, 1 times 20, then 2 times 16, 4 times 12.80, we get these amounts. To get the total direct labor cost, we multiply. To get the average direct labor cost, this one divided by the number of units. Of course, with the decrease employed on the numerator, and then we divide that by a certain number in the divisor, which doubled, and the multiplication also doubled somewhere but decreased by the 20%, then that doubling is like canceled. So that what is remaining or what is going rather to remain would be the impact of the decrease, which is 20%. And therefore, that's going to result to a decrease of 20%. So that is what I meant, right? Because the numerator here would be the unit times this one times the direct labor cost, right? And then it doubles later on. We divide that by the average unit, which has also doubled. So the doubling is canceled. That's what my point is. The learning curve rate then is 80%. It has been said here. 20% learning rate, and so the learning curve is 80%. How do we do that? Based on the direct labor hours that we've had, that is 16 hours divided by 20 hours. So how do we get that? That's 1 times 2020. Then 2 times 16, 32, right? So in terms of these parts here, 16 divided by 20, 12.8 divided by 16, and so on, that's 80%. If based on average direct labor cost, 480 divided by 600. But guys, let me just tell you again that the 20% learning rate is there. So in other words, the learning curve rate is going to be 100% minus the percentage. So that's going to be under the learning curve analysis, all right, or the theory. This is also based on the Pareto rule because of the usage of 80%, 20% items. To continue, this is now the SPA or strategic profitability analysis that I've mentioned a while ago. SPA is not special power of attorney, that's law. This is management advisory services. So that's strategic profitability analysis for internal reporting purposes and for management. So the purpose of this one really is to evaluate the success of a strategy. Strategy is any action or goal or step or procedure, or it could be a system that is geared towards the achievement of a long-term endeavor or perspective. So strategies could be specific, really courses of actions or steps that would achieve the long-term goals and objectives of the company. If you have visited our discussions about strategic management concepts or perspectives, then you have already met the balanced scorecard with the 4 areas and perspectives. So some would be the internal processes perspectives, the financial perspectives, the customer perspectives, learning and growth or adaptability perspectives. So those are the 4. And these are now the factors that we have to know of: the growth, price recovery, and productivity factors. So growth would see perhaps the scale of the business to be going up. There's an additional market or shares of market would increase in terms of percentages, or additional lines of products. Could be that additional buildings could be there or branches, etc. Price recovery is being able to really earn out of the price set. And then productivity has something to do with our production. All right, so here are the performances of the company, BS company, in the years 2006 and 2007. And here are the items on the income statement, the revenues down to profit. Then we can have here the percentage of change. So to compute the percentage of change, we can have the, for example, prior year. Then we can also, for example, like get the difference first. of 6 million. So 16 minus 22 is 6. And then that's 6 divided by 16. If you can actually divide that, if you are having your calculators with you. So that's going to be a different amount, but then it is shown here that the percentage of change is 10%. All right, so that's 10% being shown to us. But then if we would like to know the percentage of sales change increase, that's not 10%, that's 22 divided by 16. 1.375 minus 1, that's 0.375 or 37.5% increase of sales. So perhaps this has something to do later on. Anyway, to continue, let's check. Okay, so the change is attributed really on the quantity sold, so not on the price. So if we compute 440 divided by 400, that's 1.10 or 110%. Minus 100%, so the change is 10%. So this goes to say that the price then remains constant, but the quantity increased. But we will see. We will see later on because the changes could be multiple. Okay, so indeed it is shown here that the sales price increased. So meaning the variances or the growth or the changes of amounts, or it could be the decrease also, would be multiple. So in fact, we have seen that the quantity sold and the sales price has increased. Okay, so that is already answered. Then we have the actual direct materials quantity. So changed also, price changed. So let's compute now. Is how is this DM productivity of, it's not clear, but that could be what? Or this could be what? 400,000 divided by 0.50. And then we have here also standard DM quantity based on 2006 sales. So that's 440,000. Okay, so this could be erroneous, right? So this is the DM, that is our concern of DM could be direct materials. Okay, so direct materials. We have your materials, direct labor, and other expenses. All right, so for the direct materials growth change, that's 800,000 supposedly here. Okay, that's why I'm curious. Why is it 0.5? So this is an error here. 400,000 divided by 0.5, that's 800,000. That's for the standard DM quantity based on 2006 sales then, right? Yeah, this is 2006, this is 2006 perhaps, but it is quantity based on 2000. It's 7. It's 7. 2007 sales. 440,000 divided by 0.5. That's 880,000. So the difference is 80,000, which is unfavorable. Why? Because it means that the cost has increased. So with more costs, profitability would decrease. So that would be unfavorable. Then the contents here are not that clear, so we are making sense out of these items. Hopefully you are with me. This is the best quality that I've got in terms of these parts. Anyhow, so to continue, DM growth change, then as what I've said, direct materials, that's unfavorable. Productivity variance is, what is 968,000 minus 880,000? Let us check what is that or how is that arrived at. All right, in fact, the explanation here is that these 800,000, this is error again, and these 880,000 are in units, not in pesos. So you have here the 968,000 actual direct materials quantity minus the 880,000, that's 88,000 unfavorable. So this means that the actual direct materials is lesser than the standard, right? Or how is that? in this part here rather. So in this case, going back, the direct material productivity is somehow different from the rest of the figure. So that's why variances could be arrived at. Of course, we've known that about variances. And then another one is the growth change is unfavorable because the 800,000 is lower than 880,000. And then on the other hand, also the actual is higher than than the standard. So that's also unfavorable to the company. Standard is what is set. Then for direct labor hours actual, you have here 200,000 hours. Yeah, these are hours. These are units here above our pesos. So you also have the rates given. So actual direct labor rate has shown 3 pesos unfavorable since the actual in 2007 is greater than in 2006. Then for DL, yeah, this is a measure. DM productivity measure that is at 2. This is 2. Okay, so probably there is an error somewhere on this part here, right? So what could be the amount? That could be, yeah. This has to be 800,000. 400,000 divided by 800,000, then oh my, because of the errors and the words here, we are keeping this very long. But anyway, so 400,000 divided by 800,000 pounds, that's 0.5. So this 0.5 is divided by this part here. It was 880,000. And then that's where we analyze the growth, change, and productivity variance. So according to growth, change, and productivity factor or growth factor for growth change, right? So for direct labor productivity measure, that's 400,000 in 2006 divided by our 200,000 for the direct labor hours. Okay, so you have the given item. Okay, given item here. So in other words, we use the quantity sold then in order for us to compute the measure. Okay, I think that's the point that was not highlighted a while ago. That the quantity sold is used as the numerator divided by the specific item that we are looking into, could be direct materials or direct labor, and the answer or quotient is going to be the measure. So just like your 400,000 quantity sold divided by the actual direct materials quantity used of 800,000, so we get 0.5, and that's the measure that we divided with the 440,000 of 2007 to get the standard direct materials quantity based on 2006 data. So the previous year is becoming the standard. Okay, and that will be used in the next year to compare with the actual here to get our variance. Okay, and then of course there is also the growth, which is unfavorable. Productivity, that's the point of productivity for the measure. And that's why here 400,000 quantity units sold divided by 200,000 equals 2. That's the measure. Then 440,000 units sold in 2007 divided by 2, that's 220,000 for 2007 based on 2006 data. 220,000 minus the previous year. So in terms of growth, there is unfavorable, which means that the growth has actually been unfavorable because direct labor, when it grows, would result to higher costs of labor. So that's why it is unfavorable. Also, productivity is unfavorable because this would involve higher costs. 264,000 in this case minus the 220,000 is 44,000 unfavorable with higher cost. And we can also say then the learning point here is that actually the variance, for example, for direct materials is simply the difference of the costs of them. So whereas it is not shown here in terms of the two, but we can basically check or multiply. So that's 400,000 times 40, that's 16 million. 44 times, okay, 10,000, that's 440,000. So 440,000 is the product of certain numbers. It's not given, it's quantity sold. So 440,000 times 50, that's 22 million. So 22 million minus 16 million is 6, right? 6. So that is the difference. That is the difference of the revenues I said a while ago. Then we can notice that really the variance of direct materials total is 80 plus 88. That's 168,000. Okay, that's 168,000. For the direct labor hours, that's 64,000. Okay, so that can also be seen here on the respective example. So you have the growth factor and so on, and then the formulas are being shown here. So in terms though of computations, in terms of which is favorable and unfavorable, so we just have to go back to the basic rule that if the respective costs would increase with the standard versus actual. So if the actual is higher than the standard, then that's going to be favorable for the company. And the opposite is unfavorable because you want higher revenues in the actual. But if this is cost now, just like the direct materials and direct labor items discussed a while ago, so the increase would be unfavorable while the decrease would be favorable. So decrease of the actual versus standard. All right, so I hope that is clear. And this is also one way to check the change in the profit. So 2,880,000. We can scrutinize, we can dissect this into growth, price recovery, and the productivity factor. And the following items here at the bottom are the formulas. If this is real life, so what we can do is that we just have to take note of the formulas and apply. We can just do Excel. In fact, these items here are normally not the items that would come out even in CPA board examinations. All right. So hopefully we learned something from these parts here. But these parts here we got longer again because of some parts which are anyway incorrect in nature. And this part here which is quite hazy to look at. All right, so continue. Oh, so we are done with that. That took us long or longer. Next is backflash costing or JIT and backflash costing. And just in time philosophy, we mean that the materials are there or available and labor is also available. So we have to have plenty of suppliers and plenty of laborers or workers to support us along the way, as well as the machines to be used in case that there would be disruptions and in case if there are things beyond our control. So there are available stocks or contacts. There are. So they are available as soon as orders are made by customers. And the goods can be delivered to the customers just in time to sustain or to support their respective needs. So that's why we said, and just in time, the trigger point is traced from the date a customer made an order. And from there, the order will, of course, dictate as to the products to be furnished or provided or delivered. And then the products would also dictate or would also relate to the specific raw materials, labor, and overhead to be made. So that's why he said that it should be the consideration of availability is highlighted along the way. It should be the paramount consideration, availability of the items for the production of goods. Otherwise, we cannot apply just in time. So that's why also not a lot of corporations or companies are applying this one. Now, how do we cost the respective philosophy? We have to use backflash costing. The new manufacturing setup suggests that materials inventory and work in process inventory would be an insignificant cost in the production process, right? Because we don't have to maintain our materials. Our suppliers will be maintaining them. And when we need them because of certain orders from our customers or buyers or consumers, then we just have to contact our respective suppliers. And also, if direct labor would be there, we have anyway our employees and contacts also are available just in case, and machines also can be repaired immediately. So that's why maintenance is very important for the machines and other items for building the production area for just-in-time philosophy. Then let me read. Backflash costing records costs until after the events have taken place. Then costs are worked backwards to flush out the manufacturing costs. So meaning we have to do the reverse flow from our outputs, then going back to the inputs of production, which are the manufacturing costs, direct materials, direct labor, and factory overhead, and we remove the conversion costs then, because we have to focus on the items related to raw materials, but also there would be items related to conversion, but we have to flush out them or to remove them. So the point where the material costs are backflushed is called the trigger point. So that's why I said the highlight really here is the materials. Okay, so there are three events that trigger the records kept in many backflush accounting systems. So you have the sale of goods, in which, of course, the revenue normally is considered, completion of production, the second trigger point, and the purchase of materials. So in a true GIT system where there is absolutely no raw materials held in hand, this trigger point is irrelevant. However, while companies have not yet reached the dream of, or I think this is the dream of backflush environment, the use of the materials purchase date and the date of sale or production would still be popular. So purchase date and the date of sale and the production. Okay, so here are certain situations. So basically, this is all about journalizing of transactions. And I think that this is something close to our heart, even from previous accounting subjects like accounting one. We know how to journalize. So this is Aquatic Corporation using JIT, and we have to use Backflash accounting system. So how do we know if we have to use Backflash accounting system? It has to be stated in the problem. All right, so we have here the raw materials purchases, standard cost per unit, production cost, and the sales. So how do we journalize? If there's a purchase, no entry, conversion cost, there is, finishing of goods, the trigger point, no entry, and during the sale, because this is backflash costing, the trigger point is the date of sale. So that's the time that we have to recognize the cost of goods sold. So we have conversion 62, and accounts payable 126 coming from the raw materials purchases. So raw materials and the conversion costs. We said that it's on the purchase. Okay. Next would be the date of production. So no entry on the purchase, incurrence, yes. When finished goods are completed, so we have to recognize the raw materials purchases. Then why is that? Because anyway, just like in the previous problem, there was no mention as to whether like we have to use the direct materials used, but then this is backflash costing, so we really have to focus with purchases. If this is ordinary type of situation like production, then we will focus with the direct materials used. So hopefully that is also highlighted. Focus on the purchases. 126,000 finished goods and accounts payable. Then to close conversion cost to cost of goods sold. So that's why we have here just to transfer the conversion cost of debit of B to credit and debit cost of goods sold. Then finished goods to cost of goods sold also. So basically, it's like the same overall. It's just a matter of differences in journal entries. The backflash costing of direct material cost and also the recording of the creditor's account is made at the date of completing the production. As such, finished goods inventory is maintained. But then this would be backflashed to cost of goods sold. That is letter E. Conversion costs are recorded at the date of incurrence. This part here is the same. So with point of sale or the date of sale as the triggering point, then we can notice that raw material purchases has no entry as well as finished goods. The conversion cost as incurred will be recorded. Everything will be closed here to cost of goods sold. But here, because the triggering point is the production, that's why we also have to journalize. Next is backflash costing. The trigger points are materials, purchases, and the point of sale. So that's why we record also. We have to use the raw and in-process account. So we don't use just the raw materials purchases given. We have to compute the raw and in process. So hopefully it's here or discussed somewhere. But then we have here the journal entries. So in this particular case, if you're wondering as to how this amount is computed, that is basically just direct materials and indirect materials added. All right, so that's how you got this raw and in-process account. Still about raw materials purchases. Conversion costs here given. Then finished goods completed. Let's check. This is not the trigger point. Only the materials purchases or raw materials purchases, including indirect and the point of sale. Okay, so raw materials, as stated here, is not necessarily direct. It also includes indirect. Then materials backflashed. So you have the direct materials beginning at 2000. We have that. Direct material purchases, and then the ending 1.5. So this probably is given here. So this is not like stated here somewhere. So this has to be given. Okay, so 2000 plus 126,000 minus 1.5 is 126,500. So that would be for the raw and in process. For closing of conversion cost to cost of goods sold, it's given. The adjustment to RIP account on conversion cost is 900 minus 600, that's 300. Okay, so that's why we got this entry here to close further the raw in progress. RIP is raw in progress. Okay, so let's continue. What about if the trigger points are materials purchases and point of production? So we have here the example purchases and the production. So that's why in the completion of finished goods, there has to be a trigger point, but we can notice that the amounts are the same. Same in the previous example, same, even the direct materials to be backflushed. And then we close the conversion cost and we transfer the finished goods to cost of goods sold also. So how is that done? Finished goods beginning, that's at 3.1. Okay, so that's the reason we have an example here, which is given 3.1. Then 3.1 plus the finished goods 126,500 or 126,500 minus 1.5 is the amount. So this is the amount to be closed to cost of goods sold. Finished goods will be the credit. And finally, adjustment of or on RIP and FG, the raw in process and the finished goods balances on conversion costs. So cost of goods sold is at 700. That's 1.2 minus 2.2. Here, 1.2 minus 2.2, that's 1,000. 2,200 minus 1,210. If that is better, then 600 and 900 is 300. Okay, so for a total of 1 All right. So those are the items to be closed. Anyway, in terms of journalizing of this particular nature, normally this will be in a form of multiple choice in the board examination and in a form of given journal entries. So there wouldn't be much of the worries. We just have to take note of the concept so that we can easily select as to what proper account title should there be. Okay, so in this version we're in, let's go back. The assumption is that the trigger points are materials purchases and point of production. So in the material purchases, there has to be the recording of the raw and in process, if not raw in process, or raw and in process. That's the correct or complete meaning of RIP because we are talking about the raw materials and the in process items. Okay, good. Then immediately recognize at the date or on the date of receipt for raw materials purchases. That's true. Then the debit is made to the raw and in process account to impress that there's no material stored in the warehouse, however, still in process of production. Okay, that's also true. Then aside from that, the cost of materials used is backflashed at the date of completing the production because again, that's our basis. So the trigger points are materials purchases and point of production. All right. So basically this talks about backflash costing. Then finished goods inventory account is maintained and is later on transferred to the cost of goods sold, which is also true in the previous examples. And conversion costs are recorded at the date of incurrence, all right? Which is, again, these two are true in the previous latter examples if, for example, the triggering point would be the point of sale and the point of production, all right? What about standard costing? This is also applied, or this can be applied in terms of the getting of variances. So we have the actual versus the standard conversion cost. And they are to be closed the cost of goods sold account. Yeah. So as a principle in closing variances, remember the first rule is that if it is immaterial, we can close it to cost of goods sold. If it is material, then we are going to close it or allocate it to work in process inventory, to finished goods, and to cost of goods sold. So it wouldn't affect raw materials inventory because the variances here, conversion costs are talked about, in which the conversion costs composed of direct labor and the factory overhead are the items connected to the work in process and the conversion cost as well as the cost of goods sold. All right, so that ends part 2. And I've decided we'll have part 3 for this one because the concepts are very long. So stay tuned for part 3 and see you next time.